Well, the Fed did it again. Why banking issues may push mortgage rates down, and what sectors of the construction market are most likely to do well with resulting market conditions. I'm Jason Schmidt, and this is the Weekly Mail. So over the past several weeks, all the financial shamans have been gathered, drinking their special herbal tea and throwing animal bones out on the table, reading the results to hopefully predict what the Fed would do in last week's March announcement. Was it going to be a pause? Was it going to be an increase? Would there even be a pivot downward? There was no shortage of predictions. But then in the middle of all of that came along the small banking crisis, and all conventional bets were off. The tea consumption of the shamans increased significantly, the reading of the stars began, and the financial news outlets were on an absolute tear. And then, last week, the Fed bucked what markets were hoping for and raised rates again by 25 basis points, that's 0.25%, to a new target range of 4.75 to 5%. Many were hoping that after the Silicon Valley and Signature Bank collapses, and even further ensuing banking concerns with First Republic and Credit Suisse, though Credit Suisse has had problems for a long time, that the brakes would be hit on the increases. But no such luck. What I find interesting about all of this, though, is how some of the fallout may, in a weird way, help what has been an otherwise struggling real estate market. But before we go any further, please remember to like and subscribe to stay up to date with our real estate and financial market news. Also, over 80% of viewers of our content are not subscribed, so please be sure to subscribe and like so we're able to grow this channel as much as possible and provide more valuable and frequent content. So the banking collapses have now captured the headlines, stoking concerns that range from questionable liquidity to outright insolvency. Now, I'm not here to speculate on what will or won't happen within the banking system, and I say that principally because the Treasury Department has made it clear that they, along with the Fed, will do whatever to protect depositors. There are already new lending facilities and market operations in place, and the message has been sent and is clear that the banking and financial systems are secured and trustworthy. Whatever that means, coming from the very same people who created this mess to begin with. Now, the Fed's rate increase would have conventional wisdom thinking that as bond prices are pushed further down, mortgage interest rates would eventually be pushed up. But these banking issues have created fear in the broader financial markets, pushing investors into any perception of safety, which, as it turns out, are the very same bond markets that would otherwise suffer even further losses as a result of a rising rate environment. Funny how these things kind of work out sometimes. This influx of capital into government securities and residential mortgage-backed securities have offset the rate fears we've had and have pushed mortgage rates farther downward. This combo of banking concern plus an aggressive rate environment has also now moved into commercial real estate sectors, prompting additional concerns that as commercial paper comes due, debtors will be unable to refinance at significantly higher rates while also being unable to pay off any note that comes due. Small to mid-sized banks in the US are reported to hold around $2.3 trillion in commercial paper, between 75 and 80% of all commercial loans held by US banks. Following the COVID-era office exodus, many large office buildings, office parks, office complexes, etc., remain largely vacant and are very unlikely, at least in the near term, to be filled and pass requisite underwriting for any new refinance, let alone new lending. This fear is compounding that already tenuous narrative on the banking sector, driving more investment into safer areas of the market, bonds. This concentrated movement, partially into mortgage-backed securities, will likely keep rates below where they otherwise would be in the greater slice of capital placement following Fed moves, but only as long as this remains a better alternative, which brings me to construction. An area of this market where these factors could come together and provide a basis for growth in an otherwise shrinking lending environment is the custom home builder sector. Though the rate environment for traditional home purchasing may remain lower for a period of time, more broad lending practices are likely to tighten should there be a continued perception of crisis within the banking sector. This is the flip side of there being a positive outcome to the flood of investment into bond markets. Until uncertainty is diminished, small to mid-sized banks, which represent a huge portion of the real estate lending market, will likely look towards capital preservation efforts, which is just a snazzy way of saying they're going to reduce lending. And this is likely to affect the lower end of the value spectrum more heavily, as those borrowers tend to be less secure in their credit profile than the upper end of the market. Interestingly, my experience has been that many luxury custom builders do not principally rely upon traditional or institutional lending for spec builds or land purchases. They largely rely on a combination of their own capital and private money. And private money can earn a greater return funding lot takedowns and construction projects than they otherwise would in a highly volatile stock market, let's say. And because the rate environment at the moment is loosening, we're seeing more interest from end users for these projects. But this is location specific. Nationally, the luxury housing sector took a big hit in 2022, with transactions declining by almost 40% year over year, ending in November of last year. When we look at markets like those within Florida, luxury sectors are up relative to many other areas of the country and are showing no immediate signs of slowing as national migration continues in this region and international buyers look to shore up their own capital preservation efforts by investing in U.S. real estate. Miami and Tampa are usual suspects for seeing a climb in luxury growth, but here in Central Florida, we're seeing that same trend. Total 2022 luxury transactions were up about 2.5%, when the balance of the market was down by over 30%. And 2023, though slowing some in comparison to last year, is nowhere near the slowed pace of the general market and other regional luxury pockets around the country. All good indicators for luxury custom home builders. Now, the logical concern here in this conversation is sentiment or fear. Fear of the unknown, fear of the future, fear of risk. Will the market noise about pending recession and a potential crisis in the banking sector have a lasting effect? Only time will tell. If small to mid-sized banks are unable to settle the uneasiness amongst depositors or general market perception about their positioning, we could have a significant problem on our hands, one that would be just awful, frankly. And what the requisite government agencies would do in response to that would almost certainly make it worse. But on the other hand, if we can get through and both the markets and depositors are reassured by the actions of the Treasury and the Federal Reserve, which are designed to provide that comfort everyone is looking for, we'll have shorter term issues to maneuver through, but the collapse that has been pushed by the doom and gloom sector of talking heads will be very unlikely. The broad economy slowing through the balance of 2023 is already baked into the cake, but slowing versus collapsing are two very different scenarios. If you watch this video up here in the corner, you'll see that our position here in Central Florida is better than many. Our market continues to attract both national as well as international investment, and our prospects for longer-term growth are much sounder in both aggregate demand and demographic base than many other areas of the country. And like I say about everything, there is always opportunity. Keep your nose down and seek it out. In the best of times and the worst of times, there are always players in the market buying and selling. Your ability to connect and add value to those players will allow you to not only survive, but thrive. And when we all come out on the other end of things, you'll be in a position to write your own check. Go work harder than the person next to you. If you connect with more people and make fewer excuses about failures, you'll be well on your way. If you'd like for us to include any specific market information or topic of discussion, please let us know either in the comments or if you are receiving the weekly mail emails, simply reply to that message and let us know. Remember, please like, share, and subscribe to either our social platforms or to the weekly mail email distribution list. With that, I hope to connect with you soon.